Hi, it's Brian Cushing from Mortgage Insiders here with your weekly update on Fed Week. We do have the Federal Reserve Open Market Committee coming out with the conclusion of their two-day meeting will be Wednesday, September the 20th. That meeting comes out with a statement and then a press conference. And usually that press conference is pretty exciting, and hopefully it'll move the markets in a much better way. We're going to take a look at the charts right now. We are testing the high points in the longer-term interest rates. The 10-year Treasury specifically is hitting the high that we saw last November. So let's take a look. So we're going to start with the 10-year Treasury today. It actually is down slightly. This is actually after a little bit of a test of the ceiling. And what we're looking at first is a longer-term picture for the last year. We can see the 10-year Treasury has hit just below this Fibonacci retracement level, this 4.362 rate. Just below that, 4.296. We're hovering right in the middle of that today. We most recently hit that back on August the 21st. We had some relief. We've bounced back up and hung around this line around 4.3%. And just last few days, just anticipation of the Fed meeting, which we're going to take a little closer look at. We're at 4.33% today. Like I said, just testing that high that we had just recently hit back in August and late last year. So prior to the Fed meeting, we are keeping an eye on what could be a volatile run. We could go much higher if we break above this level, if the Fed has any hawkish tone or leads us to believe that they're going to continue to raise rates. Most of the market believes the Fed will not be raising rates at this most recent meeting, and that they could give us some insights into how long they might hold the federal funds rate high, meaning that this could be the high point of the federal funds rate, which is just over 5.25 to 5.5%. Now that's more than 1% higher than the 10-year Treasury is yielding right now. So the market would tell us that over the next 10 years, they don't feel the federal funds rate is going to stay this high. The question is how long? And that takes us back to that 2-year, 10-year inversion we looked at. Over the next 2 years, we see the rate well over 5%. And the 2-year Treasury, we can take a look at, 5.06%. The 1 year at 5.43%, more indicative of the time frame that the market would believe the Feds would hold their short-term interest rate, their overnight rate, high. This is basically the rate of the federal funds rate. So you can get a 1-year Treasury investment at about that interest rate, and over the next 2 years, we see it coming down, but not very much. The 7-year cycle, 4.41. Even the 30-year is a 4.4%. So it's really just the 10-year, and this is the most heavily traded coupon in the U.S. Treasury as far as the liquidity for government funding. So they do issue all these bonds constantly, and that's why this market is so liquid, and we can see what's happening live when it comes to a wide variety of interest rates. So we're going to watch closely this Wednesday when the Fed Chairman Jerome Powell comes out with his press conference around 11 a.m. West Coast time, Pacific time. Just before that, the statement will come out from the Federal Reserve, and we'll be keeping an eye on it and coming back to you next week.